Okay? So what we're going to do is we're going to take a look at the standard transactions which a government has. Standard operating transaction, collection of revenues, spending money, issuing notes. We'll be recording this from two perspectives. One based on the modified accrual basis, and the other based on full accrual basis. And in the book, for those of you who looked at this, that's called dual track accounting. So don't get confused. Accrual basis, bless you. Accrual basis is based on, the book refers to them as governmental activities. That's how they say it. Instead of saying accrual basis, they say governmental activities. Okay? And general fund entries are made on modified accrual basis. So this is what we're going to be doing. We're going to analyze operating transactions at both the government-wide and fund level. We'll prepare adjusting entries at year-end and pre-closing trial balance. There'll be some closing journal entries. There's this interfund and intra-fund transactions, something to talk about permanent fund, and one of the important areas in this chapter, which is a description of exchange and non-exchange transaction. Now, to you, some of you, this might seem, this exchange and non-exchange transaction seems like a very thick concept. But you'll realize, as long as you keep it, if you understand what the term means, exchange and non-exchange, you'll get what we mean here. So this is, there's a lot of material to cover, but we are going to try to see what we can do here. Just a quick revision, okay? Measurement focus, governmental funds, what do they focus on? Current financial resources. Don't ever forget that, okay? Accrual basis focuses on what? Flow of economic resources. Flow of financial resources and flow of economic resources. Another thing that you see in the measurement focus, do you see any long-term assets or long-term liabilities? No. So if I asked you a question and said, should long-term capital assets show up on a governmental balance sheet, what would your answer be? No. Should long-term liabilities show up in a governmental balance sheet? No. If I said to you, do long-term capital assets show up in a government-wide financial statement, what would you say? Yes, same thing. So don't forget that, okay? And so this is a short-term focus, and that's why we say that it doesn't appear there. Okay. So as I said to you, the book uses this dual track approach, which has different effects based on how we record the transaction itself. And remember, when you look at full accrual basis, you're going to come across terms such as expenses. When you look at modified accrual basis, you'll come across terms such as expenditures, okay? So that's what we'll tell you. When you come across terms which are expenses, it won't be one line item. It would be expenses being charged to different functions, okay? At the governmental funds level, we don't do that, okay? So let's start off with the very first piece, the journal entry itself. What do you need to do before you can spend money in governments? You need to have a budget pass, right? Can you spend money without a budget? No, you'll be in trouble. Okay, so you cannot do that. And so you need to be able to, and that's what's unique about governmental accounting, is that we record budgetary transactions in our books. It's very unlike commercial accounting. So here, what are we doing? We're recording a budget. And the way we do this is we've got estimated revenues, we debit. Remember, once again, going over estimated and real revenues. What is an estimated revenue account? A budgetary account, right? Which always has the opposite balance of the real revenue account. Our revenue account has what? A credit balance. So a budgetary account would have a debit balance, and that's why we do that. Appropriations are what we'll be spending. When we spend something, the expenditures always have a debit balance. So appropriations will have what? A credit balance. Okay? It'd be nice if we could say estimated expenditures, but we don't use that term. We call that appropriation. All right? And the difference is the plug that you see here. So what's happening here about this government? What can you tell me about this? They are going to be spending more than they are going to be receiving. Good, bad, or indifferent? Okay. And you know what? The answer that I just got from Jenna right now was bad, and that's the reaction of most people. Bad. That's the way people look at it. But not necessarily. Because, and I'll give you an example why it's not necessary. If you had a big rainy day fund balance, and let's just assume, okay, let's take a real example. Let's say you were one of the shore towns which got hit by Sandy, and a lot of properties got wiped off. When properties disappear, what happens to the taxes on those properties? They disappear. Did the town anticipate receiving those taxes? Yes, before Sandy. Now they don't have it. So where do they have to go to? The last thing they can do is raise the taxes for everybody else while we're in the middle of the year. So what do? They go back into their rainy day fund balance and take the money out to balance their budget. So the question is, what should your savings account be as a percentage of your budget, your rainy day fund balance? It's all over. 5%, 10%, 15%, 20%. If you're the CFO, would you like more or less in the rainy day fund balance? More. Good. That's basically the reaction. Because you want to have money available for contingencies. Yes, Andrew?
What happens if it was running at a deficit before and doesn't have?
Well,
Do some cities have?
Yeah, no, actually it's a very good question you asked. In New Jersey and in many states, in fact all states, you cannot adopt a budget which is which doesn't have revenues or fund balance to support. The only folks who are allowed to do that, federal government. Why? Because they can print money. They can tell the Treasury, go ahead, print those dollar bills. All right? So they can do that, but not state governments cannot do that. Yeah. So, in the program that I run, there's a course in public financial management. And we talk a whole semester about public policy and how to deal with these types of issues. And so even though we're doing this very quickly right now, it's a very, very important question. And there's really no right answer. But there is one right answer. You should always have a cushion. Now, I want you to, and this is not talked about in the book, but who might take the opposite position of what he said? Yeah. Yeah. Yes. Very good point. Actually, I didn't think about that, but you're absolutely right. Because what are you doing? You're using past revenues which have been put in the fund balance to balance your current budget. And next year, what's going to happen? The hole's going to get bigger, right? If you're only collecting, let's say, if your estimated revenues were less by 5%, right? Next year, with the inflation of, let's say, another 5%, you'd have to collect what? At least 10% to balance your budget. And that's a big issue in terms of inter-period equity. But what I was going to refer to was a different issue, which is this. You're the taxpayer. What would you like your taxes to be, high or low? Low taxes. Estimated revenues are derived from what? Taxes, right? The lesser the amount, the lesser your taxes are, right? So what would you want him to do? Use more of his fund balance. So your taxes could be low. Now that's a short-sighted way of looking at it, right? Because in the long term it doesn't work, but that's the issue in New Jersey. In fact, I don't know if you saw, I know several towns are having their school elections today, where they are authorizing ordinances for expansion of schools or facilities. I know I saw that something this morning, that you go out and in New Jersey you're required before you go out and spend $18 million on baseball fields or other things at the school that you get the approval of the citizens. So that is a big issue, that balancing act. The taxpayers saying don't keep too much of a fund balance because use it to lower your taxes, and the city hall saying let's keep some. Okay. Now let's go into the other unique aspect, and this is really isn't new. Remember what I said to you about encumbrance accounting? This is a very strange thing, only again found in governmental accounting. What's encumbrance accounting? Encumbrance accounting, very simply, is a way to prevent you from overspending your budget. Okay? That's what it does. It prevents you from overspending. It's an additional control that's built in. Okay? And basically what happens is if you had a computerized accounting system for a municipality, as soon as you cut a purchase order or initiate something like that, you will encumber the funds. That's where the word encumbrance comes from. You encumber those funds. That encumbrance goes against your appropriations. Okay? And so we're going to learn this encumbrance cycle and how that works. Okay? So this is what happens. In this place, supplies worth $420,000 were ordered. And look at what happens. The first entry is, have we received the supplies yet? No. Do we have any obligation to make that payment yet? No. It's our intent to purchase what? $420,000 worth of supplies. Standard journal entry, a debit to encumbrance and encumbrance outstanding. Now, you know, the book likes to put the year. Obviously, if you're in the current year, it will be the current year, but that's fine. Either way. Everybody understand this journal entry? And it's the same entry every single time. You always debit encumbrance and you credit encumbrance outstanding. And this is how it's distributed. To general government is getting 80,000 worth, public safety is getting 210, and public works is getting 130. All right. Now we receive the item that was ordered. And seldom what you order is exactly the bill that you'd get. There'll be shipping costs, there'd be more or less. So in this case, what were the amount of supplies we received? 432,000, right? What I'd like you to do is, in your mind, for a moment, blank out this line and blank out this line. Just blank it out in your mind. And what do you see? These two entries, right? Which are the exact opposite, right? So just blank that out for a moment, okay? Could you make it in two journal entries? Yes, you could do it in two journal entries. If it makes it easier, you can separate one from the other. All right, the book puts it together. So as I said, this entry is reversed first. You can never reverse more than what your original encumbrance was. It doesn't work that way. You can do it less, but when would you do less? So you ordered 420,000, you only got 400,000 worth of supplies. What would be the amount of reversal? 400,000. You got that, right? Okay. And this payable could be as well be cash, right? Instead of, but here it's a payable, all right? Expenditure, so you got to understand this journal entry. We'll talk about inventory later. And this is expenditure ledger and encumbrance ledger. We won't go too much into this, but let's take a look at the governmental activity side. This is on what? Full accrual basis. Any encumbrance account here? This is like your commercial accounting. Any encumbrance? No. Any budgetary accounts? No. Very straightforward. Any expenditures here? No. Instead what? Expenses. And that's what happens. Very simply, we record this this way. Any questions, by the way? Let's take a look at accounting for payrolls. Remember I said to you that payroll was one area where you don't have to encumber things. It doesn't make, you don't order payroll. You don't, it's just one of those things you incur it when it's time. So we're going to just make some journal entries to record payroll. Interestingly, these journal entries are no different than the journal entries you'd make for a commercial enterprise. Because in one case we call it expenditure, in the other case we call it expenses. Okay, so on your paycheck, what do you see? You see your net pay, right? What other things do you see on your paycheck? Federal taxes withheld, what else do you see? State taxes, what else do you see on your paycheck? Social Security, what else? Unemployment insurance. Oh, you got lots of things. By the time you're done, your paycheck is, you say, what happened to my paycheck? It's gone. It's disappeared, right? That's life, right? Not to mention the medical, premiums that you have to pay, pension contribution or 401k contribution. I mean, by the time you're done, there isn't much left, right? And that's why I always tell folks that, when somebody says to you, that thing's only $1. Think about it. It's $1 after tax. How much did you have to make before you could spend that $1? More like $1.33 or more. You see that? So if somebody says to you, it's only $1. No, it's not $1. You had to earn what? $1.33 to be able to spend that. So, but I showed you this example because, I wanted to go through this because this is how we do the payroll. Expenditure, the payroll for this period was $948,000. Federal government looks like what taxes? They are the taxes, right? Social Security and federal taxes. State government, that's the state tax plus the unemployment insurance. And cash is your net pay, okay? That's going out to the employees. This is how we book the payroll. All right? This tells you the employees get paid immediately, while the federal government and state government might have to wait for a day or two. Okay, and this is how it's divided into 3 different categories. Tell me, is this really any different from this? Not really. It's the same thing. It's just one is expenditures and one is what? Expenses, right? So that's your journal entry to record payroll. But everybody know, right, that the employer has to match the employee's share of FICA, right? Social Security, right? Did you know that? Okay. That's why you ever wonder if you worked independently, you have to pay self-employment taxes. You know what that is for? That's the employer share of the Social Security. That's why do you see people who say, you know what, can I just not make you an employee? Can I just give you a check? Why? Because they save on the employer's share of Social Security. So if I were you, if somebody said that, tell them, no, I want to be an employee. I'd rather have, because they'd have to match that. They'd have to match the Social Security. But that's what this is, by the way, the additional amount. Okay, so here's the employer's share of the FICA recorded at the governmental activities. Please stop me. I'm going through these quickly because we've got quite a few of these. If there is any question you have, please, before we do this, shall we do some clicker questions? Oh, I see some sighs. Okay. All right. All right. Okay, so the first one is, please take a look at it. Can you guys read this? How are we doing? Good. How many do we have in the class today? Did you do this earlier? 50. Looks like it's everybody done? Okay. Pretty straightforward question. And well, what's the answer here? So the governmental activities column of the government-wide statement of net position differs from the general fund balance sheet in that it reports both current and non-current assets and liabilities. True or false? It is true. The key is what? The government-wide financial statement. Okay? Anybody not get that? Okay. Let's go to the next one. Question number 2. Okay, almost done. Oops, hold on a second. Did somebody really answer C? I think you need some coffee. Thank you. Thank you for doing. Can you just move it to A now before I shut this? Come on, guys. Who's here? Okay, you still very strongly believe in answer B, right? All right. I guess you don't want to do it, huh? Last chance. Okay. So, All right, the question is, under the dual track accounting approach used in the tax, recording the annual budget for the general fund requires, that's just kind of funny. We're still going. Oh, I didn't shut the poll. Okay. I didn't shut the poll. Okay, hold on a second. I got to get out of this. Here. Okay. Under the dual track accounting approach used in the tax, recording the annual budget for the general fund requires journal entries in the general journal of both the general funds and the governmental activities at the government-wide level. True or false? See, I got you. I got you. Think about it. Recording the budget requires journal entries at both the general fund and governmental activities at the government-wide level. Do we record budgets at the government-wide level? Do we? No, we don't. We got a perfect, not perfect score, but we had a perfect the other way around, okay? So, well, all right, we won't take that question because I think most people didn't get the question itself. It looked like you missed the last part of it. All right, let's take a look at the next one. By the way, do people understand why it's false? Okay. So general fund budgetary information affects only the general fund. Does it affect anything at the government-wide level? No. And that's where it came in. Okay? Yeah. Yes, it would be any governmental fund. Yeah, any government. Yeah. All right. All right, let's take a look at the next one, since we're having so much fun with this. Oops. Okay, question number 8. Oops. This is a straightforward question, at least. Okay. Okay, are we done? All right. So, what do you think? Yeah, it's pretty obvious that the answer is, you know, you're making me really feel really bad now. Either due from the federal government. Okay. Answer is a equipment, and why is that? Yeah. Yeah, it's a capital asset. Yeah. All right, let's go to one more. Okay. I keep on asking this question over and over again. Oh, sorry. Okay. Okay, much better, much better. Now it makes me feel better. Okay, that's much better because that's the definition which is available. Okay, let's go back to the to our next piece, property taxes. So why do we why is this so important in governments? Because property taxes and other form of taxes are one of the primary sources of revenues for government. And I don't know, do you know how the system works in New Jersey, property tax system? Every town has an assessor, a tax assessor, who goes out, looks at your property, and determines what it's worth. And you argue with that person and say, it's not worth this much money. It's actually worth half of this. Say, oh, you have a patio outside. You say, no, it's not a patio or a deck, it's just a walkway. All right? So you try to, that's the tax assessor. So he or she assesses the property. Now, once the property is assessed, you receive a tax bill. Okay, sometime in July or something like that, you get a tax bill for your property, and the tax bill basically says your property was worth this much money, this is what your land is worth, and this is what your building is worth. And you say to yourself, wow, I didn't know my property was worth this much. So you look around your neighbors and say, look at their properties. You go, you're very smart on the machine. You go on the computer to the property tax assessment database, and you look up what your neighbor's properties are worth. But you go one step further. You look at recent sales that have occurred to get a true value for the property. And in New Jersey, you can take that information, the surrounding assessments, properties that are sold, and go to the tax court to reduce your assessment. Okay, and a lot of people do that. And because, you know, that's money, and it's not fair that they should be paying more taxes than what it should be. So that's the tax assessor. The tax collector has the responsibility for collecting those taxes 4 times a year. I think it's August 15th, November 15th, February 15th, and May 15th. Those are the 4 dates where you pay your taxes. Yeah.
How often is it going to get assessed?
Actually, you know, it's an interesting question because New Jersey has a law that says that each town must reassess its properties once every 7 years. And Newark is an example, a prime example of what has happened in New Jersey. Newark did not want to reassess. And the reason why they didn't want to reassess was because the ratio of commercial property to residential property was lopsided. The commercial property owners are paying the bulk of the taxes. If they reassess, some of those taxes will be shifted to the residential folks. So Newark fought for years with the state of New Jersey, saying they would not reassess. I don't know if they did that recently, but it's a very contentious issue in New Jersey. So let me just explain to you one other thing, which is, so you're going out to look for a home. And one of the things you ask the person is, what are the taxes on this home? And the person says, you know, my assessed value for my land is $150,000. The home is another $100,000. So it's $250,000 assessment. and they give you their taxes on the property itself. But each town, because you assess it at different times, you're comparing apples with oranges. Let me explain to you. Because if you have a town like Newark, which has an assessment of 250 and hasn't assessed for years and years, and you compare it to a town like Jersey City, for instance, which might have just recently assessed, can you compare those numbers? No. And that's what we call, and again, I don't want to go too much into this, but I think you'll find this useful for your personal selves. What happens is, in New Jersey, we have something called a valuation ratio, assessed value ratio, which is, if you look at Newark, the properties which are assessed in Newark are at 33% of their true market value. In some other towns, it might be 100%. So what we do is we actually adjust the assessment by the percentage of that ratio. So for instance, if your home in Jersey City was assessed at 100,000, what should it be assessed in Newark if it had 0.33 as its ratio? 33,000, right? Very important, and people use that because when they fight before the tax court, they say, you know what? This is not what it is. And it's, as I said, I enjoy this area because I think this is the real world in terms of going out, especially in the real estate area, to look at this. But New Jersey is all over the lot with assessed values. But let me just go back to the subject here, which is that, so again, what does the tax assessor do? He or she makes up a list of all the properties in town. Comes up with what? Assessed value, 200 million. The mayor comes back, or the CFO, and says, you know what? I need $4 million in revenues from property taxpayers. Hard to figure out the tax rate? No. What is it? 4 million divided by 200 million to give me what? A rate, right? It's about 2%, and that would be, you will pay what? 2% of your property value as taxes. That's how that works, okay? And this is what we'll be getting into. Now, remember what I said to you? Not everybody pays their taxes. So you have to set up a provision for uncollectible taxes. In this case, remember we used 4% last time, right? And the book has kind of, actually, let's see if we can look at a quick question on this. Take a look at this question, 4.5. I know it might be a little difficult for you to read, but this question 4.5, and tell me how you would address that question. So the term is gross levy, right? Gross levy includes that uncollectible portion. And again, the calculation is, so you have 6,720,000, 4% uncollectible. It's basically what? 6,720,000 divided by what? 0.96. So what's 6,720,000 divided by 0.96? Hope it's a nice round number. 7 million? Okay, great. So here the answer, what did I do? 6,720,000 divided by 1 minus 0.04, which gives me what? 96.96. And now what do I have? I have the word is what? Gross levy. Gross levy has the uncollectible portion. You want to check the math? Take 4% of 7 million. What is that? 280,000, right? Subtract 280,000 from 7 million, you'll come up with that number that they need, right? That's how we check the math. Yeah, sure. So what we have is, of the 6,720,000, not everybody is going to pay their taxes. 4% of the folks won't. Okay? Which means we have to recover from 96%, 6,720,000. So what should be my tax rate? My tax rate should be 6,720,000 divided by 0.96, which gives me 7 million. Now, if I have 4% of 7 million not paying, I'll still end up with what? 6,720,000 that I need, right? Good. Yeah, actually in New Jersey, again, and in many states, there are different property classes. There is exempt property and non-exempt property. Churches, railroads, non-profits, and others they have exempt property. And within the non-exempt property, taxable property, we have residential, commercial, industrial. These are the different types of properties. Okay? They just give them a different class. It's not that they pay different taxes. It's just a different property class. The what? No. Actually, did you hear what the question he just asked? He said, are stocks considered property in New Jersey? Very good question. In many states, thankfully not in New Jersey, personal property, not stocks, but personal, like your car and other items, are considered personal property and are taxed. In New Jersey, it's not so. I think it's either in Maryland or Virginia where you have to pay a personal property tax too. You have to figure out what your personal property is worth, and you have to pay a tax on that on top of your real estate taxes. Yeah. Yes. Oh, absolutely. Everything that you have. Yeah. Yeah, we didn't think okay, and I talked to you about the tax rate, right? Tax rate is usually expressed, we don't say 2%. What do we say? $2 per $100. It's just the method. It's just the way things are, okay? $20 for every $1,000 worth of property value. That's what we do when we talk about, when we talk about tax rates, setting up tax rates. Now there's a note here about tax rate exceeding the statutory authority. I don't know if you know, but again, not to get too much into this, but in New Jersey there's a cap on how much your taxes can increase, your real estate property taxes. It used to be 2%. Your property taxes cannot go up by more than 2%. I think it's our governor who put that into effect. There are some things which are not included. It's called the property tax cap. In California, the same thing happened. And it's a mixed bag, because on the one hand, people won't pay too much, but on the other hand, things can get really rough. Because think about it. Does everything go up by less than 2%? No. Healthcare costs, other costs, they don't. So what do? You end up cutting corners into areas where you defer things. So have you noticed the roads, local roads, how bad they're getting? Why? Because it's either paying the employees or fixing the roads. Okay? And so what do you have? You have deferred maintenance. And that's the interperiod equity question. you're deferring it to future periods, future taxpayers, okay? And that unfortunately happens even at the federal government. But I bring these issues because I hope when you read about these, maybe one of you will become the CFO for a public sector organization. You never know, because I can tell you that's what they need. They need people who are bright and can think out of the box and can tell, because right now we've got a lot of CFOs and other municipal finance people who are ready to retire. And we don't, there's not this new generation, because the new generation doesn't want anything to do with the government. They want to stay away from it as far as possible, But this is my plug anyway. Okay. And this is what I was telling you about the assessed true value of tax assessment ratio. Remember that 33% I was talking about? In many jurisdictions, it's hard to find a ratio of 1. And again, what is this ratio? The ratio is, if your ratio was 1, your assessed value equals market value. If your ratio was, so let's say a property was worth $100,000, assessed at $100,000. Your ratio is 1. What is the market value of that property? $100,000. What if the ratio was 0.5? What do you think the market value of that property would be? 200, right? Basically, why we're dividing what? 100 by 0.5, right? So $200,000. And so that's how this ratio is used. All right, let's go through, and I'd like you to understand these journal entries because you're going to see them sooner or later. Assume revenues of 495 are required, and it is estimated that 1% will be uncollectible. See how the gross levy is calculated? 500,000. Now, we know the top part. This is what I want you to think about. First of all, general fund, right? Taxes receivable are what? 500,000, right? That's our gross levy. Revenues are what? 495. What's the uncollectible portion? 5,000. Does everyone understand this? The journal entry, right? Do you see this? This is a receivable. This is like your AR from the taxpayers, right? This is your revenue that you're booking, and this is your provision for doubtful accounts. Now, nobody asked me this question. What if you don't pay your taxes? Are they truly uncollectible? What if you decide that, you know what, I just can't pay my taxes? What can the town do? Yeah, they can actually foreclose on your property. Through a series of notices, they do something called a tax sale first, where it's like the biggest ripoff in the world that there is, where and it's kind of sad because it shouldn't be that way. So some poor retiree can't pay their taxes. The municipality goes out and sells that claim that they have against the taxes to a private investor. The private investor is going to make 18% on that money. And if they don't pay, that private investor has the right to foreclose on the property. From 9 to 18%. And it's usually retirees and others who just can't pay those taxes because the taxes have been going up. But then there are all these sharks out there. These are your investors who are out there ready to pounce on these tax sales, where they'll come in, purchase from the town. The town's happy because what do they get? They get their taxes, right? The investor does what? Pay the town the taxes on behalf of the person who hasn't paid, right? And now charges that person 9 to 18% on their money. And if they don't pay, bless you. If they don't pay, what happens? They can take it. But usually, that's the practical way of doing things. But usually what happens is that towns have the ability to foreclose on the property. That's why you ever notice something? In your mortgage payments, they always include taxes as part of your mortgage payment because they don't trust you that you're going to make that tax payment. Because what happens if you don't make the tax payment? Somebody can foreclose on that property, and what happens to the mortgager? It might be left hanging out there. So that's why they don't do that. Okay? They always make sure things like insurance and taxes are included as part of the mortgage payment. All right? I didn't mean to go into so much in depth, but since it looks like an interesting topic, I thought I'd bring this up. This entry at the governmental activities level. Any different from the last entry? Really, just think about it. This is the general fund entry, and this is the governmental activities. Just different titles to the account. Remember, taxes are always what? General revenue. Okay, so they had receivables of, what did they make? 495,000, right? At the end of the year, they got, okay, 2 more minutes, we'll take a break. I just got a signal. Okay, I won't say who did that, but thank you. No, there we have, it's actually ESP. Somebody sent me a ESP through one of the folks, But so they had receivables of what? 495, right? So they received what? 450,000. And what's the journal entry? Anything earth-shattering? No. Cash, debit, and credit of 450. How much more taxes are left to be collected? 45, and then there's that provision of 5,000, right? Now this is what we do. And I know this sounds like a little crazy, but what governments like to do is separate things into good and bad. Good receivables as opposed to delinquent receivables. So now you have at the end of the year, there was $50,000 left in the taxes receivable current, which they want to classify now as delinquent, right? Remember, this had a balance of debit of 50,000, right? So we credit that and we classify it as delinquent. We take the estimated uncollectible taxes of 5,000 and we make what? We make that delinquent. So all we're doing is, the journal entry sounds complicated. The same accounts you had before, taxes receivable, just add the word next to it, delinquent. But instead of adding that word to the title, we just create another account and just transfer it to that account. Okay? So people get confused, that's why I wanted to, but that's what we do. We're basically classifying things which were current. So I guess these guys aren't doing too good. They thought they were only going to have a collection rate of 96%, but it looks like it's much more. It's much less, actually. One more thing, interest and penalties receivable on taxes. Okay, so this is what happens. You took your current taxes, you made them delinquent. When they become delinquent, can you just go to the town hall and say, sorry, I'm late, here's my check? What do they want from you? Some interest or a penalty or something. So this is the interest and penalty on the taxes that were due. And look at it, they booked it as revenue. But you know what's the funny thing? Even within the interest and penalties, they have another uncollectible portion, I know, okay? But estimated uncollectible portion on the delinquent amount, okay? But that's what that is, okay? Yeah. Yeah, remember we had that 60 days after the end of the year? They have to, the taxes will remain owing, okay, until the book doesn't go into it, but the taxes will remain owing. The town won't write it off unless something happens to the property. Okay? So it happened with Sandy. What happened was the homes got destroyed. So the town said, okay, the homes got destroyed, but the land is still there. In some cases it wasn't. So you still have to pay taxes. Your home's gone, but you have to pay taxes on the land. Okay? In that case, they will write off the property which didn't exist. Yeah. All right, let's see if this is the end. Okay, two more slides, and then we'll take a break. I think we talked about, this is at the governmental activities level. Remember, we're taking snapshots at the general fund and governmental activities. And finally, this is what happens. Write-off of uncollectible taxes, $500 are written off, on which penalties, interest amount to $80. And now, unfortunately, they combine these two entries, but what I'd like you to do is just take a look at the titles of the account. Estimated uncollectible delinquent taxes, $500, a debit, and look at what the credit is to taxes receivable delinquent. Why do we credit taxes receivable? Because when you credit a receivable account, what do? You reduce it, right? So now it's what? $500 less because we did what? Wrote it off. And what's the write-off account? It's the estimated uncollectible delinquent taxes. Same thing with the interest and penalties receivable. We're doing the exact same thing where we're writing it off.